The market is buzzing, but most investors are missing the real opportunities hiding in plain sight. As 2026 begins, three stocks are quietly setting themselves up for explosive growth, and yet the crowd is focused elsewhere. While everyone chases the hot stock of the week, the true winners are quietly building, strengthening their cash flows, and positioning themselves for massive upside. Here's the truth. Hype moves prices in the short term, fear moves prices even faster, but value, real, measurable value, is where the intelligent investor profits. Think about it. The same companies that were ignored last year are now in prime position. Crocs, JD.com, and Oracle have all faced market skepticism, but that skepticism is exactly what creates opportunity. Why these three? Because they're at inflection points. They combine strong fundamentals, durable business models, and strategic positioning in sectors poised for growth. One stock is turning a fashion fad into a high-margin powerhouse. Another is leveraging logistics and tech infrastructure to dominate its regional market. The third is investing aggressively in AI and cloud services to capture enterprise demand at a scale most investors don't yet appreciate. Let's face it, most investors don't understand these nuances. They see headlines, price swings, and fear-inducing metrics and immediately hit sell or avoid entirely. We're diving deep into the three stocks poised to explode in January 2026, and the insights here might just change the way you see the market forever. The first stock on our list is Crocs. Yes, the foam clog everyone loves to mock, but that's precisely why it's mispriced. The market treats it like a fad, a single product gimmick that will disappear when the internet moves on. Yet, Crocs has maintained industrial-grade gross margins that most consumer footwear brands can only dream of. High margins indicate pricing power. Customers are willing to pay a premium, and the brand can raise prices without losing demand. That's a signal of durable cash flow. Crocs also recently acquired Hey Dude to expand its portfolio, a move that initially disappointed investors because Hey Dude's revenue slowed. Headlines screamed EPS numbers dipped, and the market punished the stock. But here's the nuance most investors miss. Accounting write-downs hit reported earnings, not cash flow. Crocs is still generating cash and using it strategically to buy back shares and reduce debt. The real question for investors isn't whether Crocs faced a temporary setback. The question is whether it has enough durable cash flow to sustain debt repayment, continue buybacks, and invest in future growth, even if top-line growth slows. A simple stress test shows that even if revenue growth stalls, the business remains profitable and trends and margin durability, policy and regulatory developments. The lesson here? Fear creates discounts, and if sentiment shifts even slightly from uninvestable to risky but acceptable, the stock could rebound dramatically. Patience and sizing positions appropriately are critical. Finally, Oracle, often pigeonholed as legacy tech, has been investing aggressively in cloud infrastructure and AI-ready services. Short-term metrics like free cash flow can appear weak because capital expenditures spike, but this is an investment in future revenue streams, capturing growing enterprise demand for compute, storage, and security. Investors panic when free cash flow dips, confusing investment with deterioration. The smart approach is to monitor whether operating cash flow remains strong and whether CapEx translates into durable revenue and customer lock-in. Metrics to watch: cloud infrastructure growth and enterprise adoption, backlog bookings and operating cash flow trends, conversion of CapEx into revenue, and AI market share. Oracle is on a knife edge. Execution matters, but if successful, multiples could expand and growth could accelerate without needing rocket ship performance. Mispricing today could result in outsized returns when the market fully appreciates the company's strategic positioning. All three stocks follow a similar setup: mispricing due to narrative, temporary issues, or fear. Crocs faces narrative skepticism, JD.com faces geopolitical discounting, and Oracle faces fear over investment spending. In all cases, fundamentals are strong, cash flows are durable, and market misperception creates opportunity. The principle is simple. Emotion drives short-term prices, but cash flow drives long-term value. The stocks poised to explode in January 2026 are those where patience, discipline, and valuation-based thinking intersect. Here's the uncomfortable truth. Real opportunities rarely feel comfortable. Crocs feels uncool, JD.com feels risky, Oracle feels expensive. If everyone agreed